Welcome to Section 8, the final section of the PNJ Group Income Statement and Comprehensive Income Training Series. This section compares U.S. GAAP with IFRS on income statement and OCI requirements, and then closes the series with the internal controls and period-end checklist that govern our work at PNJ Group. By the end of this section, you will be able to identify the key differences between IAS-1 and its U.S. GAAP equivalents on statement format, expense classification, OCI recycling, and EPSU will understand the three conversion adjustments most critical for IFRS-to-GAAP transitions, apply the PNJ Group escalation ladder correctly, and execute the period-end quality controls that protect every income statement we prepare. The reason to study GAAP versus IFRS differences is not academic. For clients pursuing U.S. listings, acquiring U.S. entities, or managing dual reporting for global stakeholders, the differences between these two frameworks have direct financial statement consequences. An income statement prepared under IFRS is not a U.S. GAAP income statement with different labels. The measurement rules, presentation choices, and OCI recycling logic can diverge in ways that materially affect how performance is communicated. Understanding where the frameworks align and where they diverge is a core competency for anyone advising on these engagements. IAS-1 is the IFRS standard that addresses what U.S. GAAP handles across a SC 220 and a SC 225, the presentation of financial performance. Both frameworks share the same underlying objective: give users a clear, consistent view of how an entity performed. The differences are in the details. One visible difference is naming. IFRS prescribes specific statement titles under IAS-1 paragraph 81. U.S. GAAP is more flexible. Any of three common names is acceptable, and companies have used all three in practice. This naming difference is minor, but it signals a broader pattern. IFRS tends to prescribe minimum content more explicitly. Both frameworks give entities flexibility in income statement layout. Neither mandates a single rigidly prescribed format, but the flexibility has different contours. U.S. GAAP requires an operating income subtotal, and companies predominantly classify expenses by function: cost of goods sold, selling expenses, administrative expenses. IFRS requires a set of minimum line items under IAS-1 paragraph 82 and allows entities to present expenses either by function or by nature. Nature-based presentation groups expenses as raw materials, employee benefits, and depreciation regardless of which function incurred them. If an IFRS entity chooses the function format, it must still disclose nature information separately, a requirement with no U.S. GAAP equivalent. Three items that practitioners often expect to differ between the frameworks actually converge. Extraordinary items are prohibited under both. IFRS never permitted them, and U.S. GAAP eliminated them with a SU 2015-01. Discontinued operations both require a single net of tax presentation on the income statement face. The scope definitions differ slightly. U.S. GAAP anchors on the strategic shift criterion under a SC 200-520, while IFRS 5 defines it somewhat differently, but the financial statement treatment is structurally similar. For EPS, both a SC 260 and IAS 33 require basic and diluted EPS on the face of the income statement for entities with publicly traded shares. Here is where IFRS and U.S. GAAP diverge most visibly in OCI presentation. IAS-1 requires entities to split OCI into two distinct groups based on whether the amounts will eventually be reclassified to profit or loss. The first group, translation adjustments, cash flow hedge gains, FS securities, will recycle when the triggering event occurs, just as under U.S. GAAP. The second group, revaluation surplus on property, plant and equipment, and under the revised IAS 19, actuarial gains and losses on defined benefit plans, will never recycle to profit or loss under IFRS. These two groups must be presented separately, giving users visibility into the permanence or impermanence of each OCI category. The pension actuarial treatment is the single largest practical difference between IFRS and US GAAP OCI under the revised IAS 19. Entities recognize actuarial gains and losses in OCI immediately and permanently. They accumulate in other comprehensive income and never move to profit or loss. Under a SC 715, the same actuarial amounts go to OCI initially, but they must amortize into net income over the remaining service period of plan participants. For a client converting from IFRS to US GAAP, this means the accumulated pension OCI balance, which was intended to be permanent under IFRS, must be reconstituted as an amortizable amount that will eventually flow through the income statement. One OCI category that IFRS entities may carry has no equivalent under US GAAP. IFRS permits entities to measure property, plant and equipment, and certain intangible assets using the revaluation model, periodically restating assets to fair value. When fair value exceeds carrying amount, the gain is recognized in OCI and accumulates as revaluation surplus within equity. US GAAP prohibits upward revaluation of long-lived assets entirely. All PP and E and intangibles are carried at historical cost, less accumulated depreciation and impairment. In an IFRS-to-GAAP conversion, the revaluation surplus must be eliminated from OCI and equity, and the asset values must be restated to a cost basis. When advising a client converting from IFRS to US GAAP, three income statement and OCI adjustments are consistently the most consequential. First, eliminate any revaluation surplus. Assets must be restated to historical cost, and the accumulated OCI and equity balance removed. Second, reclassify pension actuarial amounts from permanent OCI into amortizable OCI, and build the amortization schedule required under a SC 715. Third, evaluate every discontinued operation or disposal group against the ASC 200-520 strategic shift criterion. Some items that qualify under IFRS 5 may not qualify under GAAP. All three require retrospective restatement of comparative period financial statements. The quality of every income statement and comprehensive income presentation we deliver depends on a clearly understood escalation structure. Team members perform the detailed preparation work, applying the handbook rules covered in this series, gathering support and recording entries. But any judgment call, borderline situation, or item not squarely addressed by the rules goes to the team lead before a decision is made. Team leads review all work before it leaves the team and escalate material, unusual, or estimation-heavy items to the manager. The manager provides final sign-off on material conclusions and all significant disclosures. This is not bureaucracy. It is the quality control that protects our clients and our professional reputation. Controls give the handbook rules their practical force. Revenue cutoff testing catches timing errors at the boundary of each quarter. The gross margin variance threshold, 3 percentage points against prior periods, flags unexplained cost shifts before they reach the financial statements. A OCI must be rolled forward by component every period, and reclassification amounts must tie to what was actually recycled to net income. The team lead independently recalculates EPS using the dilutive securities list confirmed against the cap table and debt agreements. And every period end requires a documented ASC 200-520 assessment for discontinued operations, even when the conclusion is that nothing qualifies. Documenting the negative conclusion is as important as documenting a positive one. The income statement and comprehensive income are the documents that most users turn to first when they want to understand how an entity performed. The rules in this series: from revenue presentation and gross versus net decisions, through EPS mechanics, to OCI components and IFRS comparison, are the framework that gives those documents credibility and comparability. GAAP and IFRS converge more than they diverge, but the places where they differ, particularly on pension, OCI, and asset revaluation, have real consequences for cross-border clients. And the controls and escalation structure at PNJ Group are what ensure we apply all of this consistently and correctly. Thank you for completing this section on IFRS comparison and period-end controls, and for completing the PNJ Group income statement and comprehensive income training series.